Thanks, Anicha, for that. Back to the market, given up its gains. So once again, a bit of a supply coming in at higher levels. Not quite sticking. Went to 48.30 in the morning, 48.20 plus. Now back down to 47.95. So the Nifty is up barely 3 points. The Sensex is up 6 points. We've given up the morning gains. Thankfully, mid-caps are still holding on to some of those gains. And the advanced decline ratio is 880 to 234. That's not too bad. So VEX is running away up to 72 now. It was 60 when the news of the promoter stake buy happened. Of course, the promoters are buying at 80, but that stock's now reached 72. So it's gone up quite a bit, 20% actually since the news broke. That's one of the more liquid names. Vetri Subramaniam is still with us. Vetri, how are you approaching the string of primary issuances now? I mean, on one hand you've got the government FPOs, on the other hand some interesting niche plays which are coming in from spaces like food in Jubilant Foodworks and then cable distribution, etc.
So I think, there is an interesting pipeline of companies coming through, and, with the IPO market, you've always got to take it, each company on its own merits, and that's the approach that we have. Wherever we've seen companies with, good business models, attractive pricing, we've definitely gone ahead and participated, and we've stayed away from some of the other issues. What I like is particularly the fact that, as you highlighted, there's a lot of more variety coming through the market, and I think there are a lot of, domestic consumption areas which have not really been reflected very well in the market so far, and some of these opportunities therefore are very interesting from that perspective.
But you guys launched a PSU fund, Vetri, and part of the premise was the fact that there was so much government paper coming in. Have you liked any of the follow-ons that have come from the government so far?
Well, we didn't participate in the NTPC IPO, FPO, but that was only because the PSU fund already owned a lot of NTPC already, so we didn't really see the need to increase that weightage any further. But I think really the true impact of a lot of these disinvestments and that you will see by the government is that effectively over a period of time, it will raise the free float in these companies quite significantly. And today when we look at the public sector companies in terms of their fundamentals, in terms of their valuations, and equally importantly in terms of the weightage that they have in the benchmark indices, their weightage in the benchmark indices is quite understated because of the fact that they suffer from low free floats. So I think strategically and tactically over the next few years, as the free float of this entire basket of companies increases, you will see a lot more institutional money getting allocated as well to these companies. And I think in some cases the increase in free float will actually help these companies bridge the valuation gap at which they currently trade relative to the broad market. So I think the theme in terms of the PSU companies is something that we're still very positive about because the companies have strong fundamentals, and I think this investment by increasing the free float will only make sure that these companies, over a period of time gain their rightful place in investor portfolios.
What is the most contrarian call that you have as a fund manager today, Vetri, which is not quite going with consensus in terms of a large overweight or a large underweight that you have in your fund relative to either the benchmark weightages or what your peer set owns?
Purely if you look at it in terms of the single largest overweight that we have, then that is largely in, I would say, the domestic consumption areas, whether it is, the whole consumer staple space, ranging from companies like ITC to Marico to, Asian Paints. So that is the single largest weightage that we have in most of our portfolios, and we're quite comfortable in that area. And we're continuing to look for, those kind of companies where we think the, strength of domestic consumption is the strong tailwind behind their backs. It's not that valuations in those areas are particularly cheap, but if I have to choose between areas where at least I believe the secular strength and the fundamentals of those areas and those companies will sort of support them over the next 4 to 5 year period, then I'm willing to accept a little bit of higher valuations in that area. So I would say that is pretty much the single largest weightage that we have in many of our funds.
Well, people have come around to the view that this is going to be a volatile year, Vetri. Are you clear about what kind of returns it may deliver? I mean, what is the risk that this may turn out to be a negative year in terms of returns for our market?
Well, actually that is quite high, and we did an analysis of this in December, and we published this where we talked about the fact that, frankly, buying the market at 17 times 1 year forward earnings, as you would have been doing in December, was not really a very favorable, the odds for a positive return over the next, in fact, 1 year or 2 years are actually highly unfavorable. Even if you look at valuations historically where market has traded between 17 to 19 times 1 year forward, the historical odds have been almost 50% of the time you end up with a negative return over 1 year, and in fact there's a reasonable high probability that you'll end up with negative returns even over 2 years. So that's just a context of the kind of risk which is posed by valuations. Obviously there is a probability that you could still end up with a positive return. But we've always believed, right from the last 2-3 months in December, or given the valuations, that the prospect of a negative year was definitely on the cards based on the kind of historical probabilities we've seen. I think the added challenge over there is really the macro-induced volatility. When we look back over the last 5 or 6 months, by any measure, volatility had gone down significantly. We are seeing early signs of a spike up again in volatility, and I think that makes handling the next 3 to 4 months far more difficult. If that volatility spikes up and the market were to go down further and sharply over the next few months, then I think the prospects for a recovery in the second half would frankly look far better.
The market has come down to about 15 times roughly, which a little bit higher than that maybe, but people really love to buy it. The long-term investors are around 12-13, where they are very juicy, and usually you end up making a lot of money. Do you see the possibility of the market retracing to those kind of valuation levels? I'm not talking about the bombed out 9-10 P's which you see in a panic, but the lower end of the band, 12-13 kind of P multiples.
What we're dealing with here, Udayan, is forward estimates, and I made this point earlier. When you look at those forward estimates, you've got to be a little careful. The 27% growth number which is being quoted for 2011, you've got a 50% plus contribution coming from the global commodity space. So really what you need to be very confident about is the performance of the global economy and commodities rather than the domestic part of the market. The domestic part of the market earnings growth is actually, as I said, perhaps more in the region of 16 or 17%. By our estimate, therefore, if you take into account the fact that we believe that some of those numbers in the global commodity space in terms of earnings are sort of overstated, or at least we believe there's a significant risk that those earnings will actually get cut over the course of the next 3 to 6 months, then maybe the actual number that we're talking about in terms of an EPS for 2011 might be closer to only about 1,010, 1,020, maybe even 1,000. Which means if you take the 10-year sort of forward P average of about 14 and a half, that could get the market down to 14,500, 14,800 over the next 3 to 6 months. I think if it gets there, it is definitely back in attractive territory. The history of markets is that it never trades exactly at attractive territory. It always tends to trade a little bit below fair value or a little bit above fair value. As long as we can keep that range tight, I think we'll do okay for this year.
Always great getting your thoughts in, Vetri. Thanks for joining in this morning. That's the view from Religare. The market has taken a disappointing turn. So in the red for the frontline indices, the mid-cap index has come off quite a bit. The breath is getting a bit tighter. We'll take a break, come back and talk about specific stocks.